EA, the publisher behind FIFA, The Sims, Battlefield, among many other titles, is about to go private in an historic 55 billion deals. Why now, and what are the implications for the gaming industry as a whole? In this video, we'll try to answer this question and dissect the number of the deals. Before we start, a couple of important remarks. First, this video contains facts and figures, but also some degree of personal opinion. If you have a different point of view, you are more than welcome to share it in the comment section below. Second, this video tries to focus on objective aspects of the transaction and the future of the gaming industry. It does not intend to speculate on possible future quality of EA releases. But now, without further ado, let's jump straight in. To understand why these deals mean so much for the gaming industry, let's move back a little. Electronic Arts, or EA, was founded in 1982 by Trip Hawkins. The vision was ambitious: treat game developers like artists. EA publishes titles across multiple game genres and platforms, built up its internal studios, and grew into one of the largest global game publishers. Over the decades, EA expanded via acquisitions, like acquiring DICE in 2006 for 24 million, now famous for Battlefield, and built out a portfolio of strong intellectual properties, including The Sims, Madden NFL, Need for Speed, FIFA, Battlefield, and many more. By combining internal development, external studios, and first-party publishing, EA became a dominant player in console, PC, and mobile gaming. But in the last decade, the industry changed. Rising costs, free-to-play models, and monopolistic pressures have squeezed margins and growth, which brings us to today's deal. In late September 2025, a consortium formed by Saudi Arabia Public Investment Fund, or PIF, Silver Lake, and Affinity Partners, led by Jared Kushner, agreed to buy EA for $55 billion in cash. EA's shareholder will receive $210 per share, which represents a premium of 25% compared to the share price before the deal's rumors. That makes this transaction one of the largest leverage buyouts in history. Of the total, the consortium will contribute around 36 billion in equity, including rollover of PIF's existing 9.9% stake, and finance 20 billion in debt. Under the new structure, EA will be delisted and operated as a private company. CEO Andrew Wilson is expected to stay. Investors justify this massive move partly by betting that AI and cost efficiencies can boost profitability enough to derive the debt loan. It's also a bet on predictability. EA has a stable portfolio of annual titles and recurring revenue sources. To evaluate whether this deal actually makes sense, let's first look at EA's financials. In fiscal year 2025, EA reported net revenue of 7.46 billion. Gross profit in the same year was around 5.92 billion, while net income stood at 1.1 billion, reflecting a 11.94% year-over-year decline, which is something to keep in mind when you're running a company. Operating cash flow, on the other hand, remained solid. For fiscal year 25, EA disclosed operating cash of 2.079 billion. These numbers show one thing: stable revenue, strong gross margin, but declining profitability, and exposure to cost pressures. So, given EA's pressured but stable financials, why go private now? Let's look together at the strategic rationales. First, freedom from quarterly scrutiny and short-term pressure. Public companies have to deliver consistent growth every quarter. Going private allows EA to invest long-term without fear of investor backlash. To be honest, this is something that lots of public companies share. Second, debt leverage and financial engineering. With the 20 billion debt, new owners can optimize capital structure, tax shield, and drive efficiencies via AI or restructuring. Third, AI as cost lever. The consortium expects AI to help cut development costs, automate assets, voice, testing, etc. Fourth, consolidation and control in gaming. With fewer remaining public gaming firms, control over IP, monetization, and licensing becomes more centralized. Fifth, geopolitical power motive. Saudi Arabia PIF already has significant gaming industry investments. This deal may be part of a broader strategy to stake claim in global entertainment. But these motives also carry with them a significant amount of risks, for example, a lot of debt, pressure to cut costs, and market concerns about the loss of creative freedom. Even for a company like EA, there are several things that can go wrong in going private. Let's look at them together. First of all, as we mentioned, the debt burden. Servicing $20 billion in debt requires aggressive margin expansion. Any underperformance risks default. Second, the creative risk and cost cutting. If AI or any tool efficiency cuts go too deep, quality or innovation could suffer. Gamers will notice for sure. Revenue slow down. EA operates in a competitive and saturated space. Growth is not easy. The regulatory and political backlash. A Saudi-backed deal raises governance, transparency, and national interest question. Some may see game washing in this deal. Retention of talent and culture. Big structural shifts, cost cuts, or creative direction changes may drive friction internally. And finally, illiquidity and exit pressure. As a private company, EA owners will seek, eventually, an exit via IPO, sale, or merger. That exit must deliver returns on this 55 billion bet. But this takeover, it's not just an EA history. It actually has massive implications for the entire gaming industry. Other large gaming companies might become targets for private equity, especially those with stable IPs and recurring revenue. Pressure on mid-tier and public gaming publishers. Fewer will survive as public entities. AI and automation will become more central, beyond games to development pipelines. And finally, the risk of consolidation, less competition, more gatekeeping power over platforms, and monetization models. An important mention goes to indie developers, for which this represents both a risk and an opportunity. In this environment, agility and authenticity become key differentiators. But what are the key lessons and takeaways of all this? First of all, that even scale has its limits. Even giants like EA must face constraints like cost, culture, and adaptability. Predictable returns matter. Stable franchises, like the one owned by EA, have predictable returns, which are very appealing for private equity. Technology and capital override legacy. If you think about the history of EA, it didn't really matter compared to the AI advancement and more in general the technological advancement in game developing and the return opportunity on the table. Transparency matters. Having a sovereign fund among your investors raises concerns and expectation beyond entertainment. At the end of the day, EA's move to go private has the potential to reshape the entire gaming industry. It is clearly a move that goes beyond gaming, and it entails financial returns and technological advancements. If you've enjoyed this video, don't forget to hit the subscribe button or leave a comment below. And see you in the next video.